Hi everyone. It's fair to say the first 6 months of 2020 has been a roller coaster for everyone. We're still reeling from the COVID-19 pandemic. We're seeing extreme race tensions in the US, and everybody is uncertain as to what the future holds. It's been a very busy time at RBA as our team juggles with working remotely. While the pandemic has created many challenges, the use of technology like DocuSign and Zoom meetings has made sure our business can continue providing our services to you in a timely fashion. We thank you for your continued patience as we try to handle your requests and queries as quickly as possible. We've had the pleasure to actually keep growing as a business, and since our last newsletter, we're delighted to welcome Skye Kennedy to the RBA family. Skye joined our Melbourne team just before we went into lockdown. She's doing a fantastic job and fitting in very well with the rest of the team. Regarding stock markets, we saw the global share market descend into chaos in late February as the COVID-19 pandemic spread. Since late March, we've seen a sharp recovery in markets due to strong stimulus from governments and also from reserve banks around the world. The speed of the recovery has actually made us a little bit nervous, and we remain conservative investors at the moment. We actually have the pleasure to be able to share some fascinating insights into the current market conditions from two of our favourite and most respected fund managers, Rhett Kessler from Pengana and Gerald from Magellan. I hope you enjoy them.
Current market conditions we think are overly exuberant, driven by both punters, retail punters, and secondly, lots of organisations that feel like they've missed out on the rally and are struggling to get involved. For several weeks now, we've been taking some money off the table and trimming some of our winners. So in summation, we think it's gotten a little hot and we've acted accordingly. We don't like to time the market, etc., but we think that Australia and New Zealand will escape relatively unscathed. We think that the ending of the drought, the robust iron ore prices, the lack of a recurrence of a COVID scare, and the very hard and early stimulus from the government will keep the economy ticking along. That's not to say there won't be quite a bit of damage in some areas, and it's going to take some time to repair, but we do think that Australia will emerge once again as a lucky country. With respect to how the stock market emerges from this, we think it will be a stock pickers market as always, and we think that hard assets are going to be really important with good yields due to the money printing presses being turned on quite loudly, both here and globally. So you'll notice the portfolio has lots of hard assets, so Telstra's, Viva REITs, Evolution Mining, Rios, etc. And we remain focused on that.
Utilities largely unaffected. Within the infrastructure space, communications really unaffected. Rail, a shorter term impact, probably toll roads, a medium term impact, airports. We do believe they'll come back to normality, but it's going to take a little bit longer. So we've reduced our allocation to infrastructure, we've increased our allocation to utilities, and we're holding a little bit more cash, so much more defensive today. Where do we see opportunity? Well, we're seeing different things in different spaces. So in the utility space, as I said, that we think the business is largely unaffected. Share prices are down slightly over the period. So we certainly see opportunity there, but it's not, it's a richer opportunity than it was a quarter ago, but again, it's not really get rich quick. In the infrastructure space, let me deal with airports first. Airports we saw come off significantly. We went from 18% airports, and today we're around about 8% airports. So we've reduced our allocation. We did retain interest in some airports where we felt they were well positioned to recover out of this. Okay, yes, it will take them a period, but we think they're well exposed to those parts of the traffic, the passenger mix that we think are going to come back first. So domestic and visiting friends and relatives and tourism rather than business. We've certainly seen some opportunities in the toll road space, and we've allocated some capital there. We saw a number of toll road companies get kind of cheap, and we took the opportunity to buy some things there. And then the final piece is energy infrastructure. Energy infrastructure, we've been relatively stable through the period. The energy infrastructure assets we're in are very high quality companies with large numbers of clients, large number of typically corporate clients with high investment grade credit. So this is APA, this is Enbridge in the US. So they may face short-term reductions in volumes or crimping of the volumes that are coming through their networks, but we feel pretty good about what they're exposed to over the longer term. So the particular opportunities we see are, I guess, in utilities. As said, it's a slightly different opportunity. And then for us, probably toll roads is where we've seen the next a big set of opportunities.
Thanks to Rhett and Gerald for their time. I hope you found these insights valuable. Watch out for the extended interview with Gerald Stack next week. Don't forget, it's end of financial year time, so remember to top up your super as soon as possible before June 30. Thanks for your time, and we'll speak to you soon. And of course, stay safe.